Well, we're moving into the most bullish part of the year. The election is, right around the corner, and Trump has the lead on the poly market. We have macro data that's coming out, and, big earnings have started to report. We're going to talk about the last time that Trump was elected and what the market did in the past, and also see what the market is doing now, and if we can find any relevancy to that. More importantly, on today's episode, I'm going to talk about how I plan on approaching this market. That's what we typically do here. So if you haven't subscribed to the channel, make sure to do so. Let's get into today's episode. All right, everybody, welcome back to the episode. NASDAQ led the way today, and as far as sectors go, we had tech and communications that outperformed, while utilities and energy and consumer staples lag. Typically, when you have consumer staples, utilities down on the bottom of the 11 sectors that make it the S&P 500, it's more of a risk-on type day, especially when you look up the leaderboard and you see tech smashing through to the leaderboard. Treasuries were rather flat, but it was a volatile session. So you can see here the 10-year yield, we started moving higher, and then we flipped around and closed basically unchanged, but at the low of the day. We do see a little bit of a negative divergence building here in the relative strength index. And you flip over to the TLT, we went from a bearish move and we closed at the high of day. So this is known as a red to green close. And we're seeing this take place with a little bit of a positive divergence there on the RSI. And the price action came down into, a volume profile over here, a point of control where we've seen a lot of volume and a lot of trade occur. So one might think, hey, if the yields are going to back off a little bit, will TLT see some reprieve? Well, if you take a look at this chart, oil has been a good leading indicator of the 10-year yield. That black line on my screen is oil. The candlestick chart, those red and green little things, that is the 10-year yield. There's been many times where oil started sinking off, and then the 10-year yield shortly followed thereafter. Meanwhile, you could see very same situations like over here where oil started ripping up higher, and then shortly thereafter, the 10-year yield followed suit. Why am I pointing this up now is because you're starting to see these two assets diverge greatly because crude oil was down amid some Middle East tensions and Israel-Lebanon talks. So we do have geopolitical risks taking place. We do know that obviously the election's around the corner, and Trump is all about drilling, right? So the common thing is about bringing energy costs down. So is this the market pricing that in? And if so, what is the 10-year yield going to do this time around? So one might think, the 10-year yield's probably going to follow suit here in the near future. But what happens if we're wrong and the 10-year yield wants to stay up here? Or what if it happens if oil starts to rise? Does that mean that we still see higher yields in the very near future? And in this current moment, I think that this move, based off of seasonality, based off of this chart, I think it's going to have to digest and or pull back in the very near future. It just has not done so yet. So I think that once some of this stuff passes, between macro data, between some geopolitical risks, between the election, I think we're going to start to see it settle down. And you could see that right here, the dollar as we crest into another new high here in the recent run-up. Meanwhile, the S&P 500, this move has postponed the move in the S&P 500, but we haven't really seen that negative correlation. And also on top of all of this, you can snap over here to gold, and gold press into new all-time high territory. Once again, on the back of a dollar that has been rising. We did have some macro data come out today, such as the JOLTS. They fell to 7.44 million. That was below expectations. We actually had consumer confidence numbers too, and those were strong, right? At 108.7, and they surpassed the expectations. We do have more macro data coming out this week. We have the personal income, personal spending. We have GDP tomorrow, and then Friday we get the big jobs report, unemployment, non-farm payrolls, and ISM manufacturing PMI. So as I previously stated, we are in the back half of this year, more of the end of the year, right? Coming into the end of October here, and you typically do get some pretty large moves from October to December. But we still have a lot of earnings on deck. We had the ones that reported today, right, before the open and then after the close. Some of the ones that missed on earnings was PayPal, McDonald's, and Ford. Meanwhile, after the bell, we had AMD and Alphabet. We had Visa, which was another big one that has definitely the potential to change order flow in the market. Google came into its upper earnings expected move, is kind of floating around up in this range. So it did reach into what the market anticipated as risk. AMD sunk off into and around its lower earnings expected move. Visa has yet to tag it, but we're kind of slightly up on that trading session. And this is all taking place while we have yet to tag this weekly expected move, right? It's only Tuesday, so we still have 3 trading days left. SMA on the 5-day moving average on the SPY 15-minute time frame is still currently declining, and we have a wide open range of risk. Now, going into tomorrow's trading session, we have an upper zone here that I'd say pay attention to for upwards risk, and then down here for potential where we can find some supportive levels. That's the daily expected move paired with the VIX implied move 2, just doing the square root of 265, and we get these type of zones. Now, hopping over here to the poly market, these are, not always going to be 100% accurate, but there's clearly a divergence taking place in the market pricing in the potential for a Trump win. So I went back and I just want to look at, what happened the last time he was elected. When you go back over here to November of 2016, and the market was sitting roughly at around, all-time highs, and we completely ripped higher. Now, is this going to be the same outcome? I don't know, because we are at all-time highs as it stands in this current moment. And the environment was a little bit different out here too. We were actually during the midst of a rate hiking cycle, and the yield curve you can see down here, it did start to steepen, but then it started coming off. But we weren't inverted or anything like that. Now we're sitting at all-time highs in the market, but we're during a rate cut cycle, interestingly enough, while the market's pressing to all-time highs. And the 10-year 3-month yield curve is still inverted, albeit it is starting to move to that uninverted state. My guess is if we do, the market is pricing in another 25 basis point cut this November, and potentially there in December too, another 25 basis point cut. So another 50 basis point cut. We know that 3-month does track the federal funds rate very, very closely. So my guess would be if the 10-year yield holds up to and around where it's at, and we start cutting, I would imagine that we're going to see this uninvert here in the very near future. So how do you approach this? Well, the market right now, if we look from just a factual perspective, the market has been reaching, from a gamma perspective, up higher, north to 6,000. You can see that right here. That's the current call wall. Right over here is about 5,800. So this tells me some levels right out of the gate that we should be focused in on. So we have 5,800 to the downside, 6,000 to the upside in the current environment. And if we go back to the prior episode, or an episode 4 weeks ago when the quarter ended, we talked about the JPM collar, and this is the collar right over here that we screenshotted, and you can see upside possibility up here at 60.20. Now, why would that be important? Well, because it was important the last quarter when we were floating around some of these key levels, and these are huge orders, and potentially as we move into and around the 6,000 or 6,020 level, what can happen is hedging activities, and that could potentially put a cap to the upside of the overall market. So if the market wants to scream higher during all of this stuff, pay very close attention to what price action does in and around and while we reach up into those potential levels. Now, if I take a look at just the S&P 500 over here, I'm using SPX 500 USD, the 65-minute chart. This is because I'm looking at the continuity of it, but you can look up SPX, and typically by CBOE, that is the more accurate, so to speak. But this works really good with gamma levels, so that's why I use it. 5850 has been a level that we've been pinned around. Nothing new there. I'd say I'm more bullish above 5850 like we did on the prior episode. And in this kind of zone, I'm really just kind of hesitant to be around doing anything. But we are still in positive gamma territory. And when we're in positive gamma territory, volatility can typically come in, right? And this is where dealers look to buy the dip and sell the rip. So if we're going to hold 5850 and the market likes what it sees on these earnings, I'd be targeting up north of 5900 and then potentially even further up to that 6000. So positive gamma is one of the most important things that I look for when I start to add exposure into these markets. The next element is the direction of the 5-day moving average. And you can see here, SPY is still kind of giving us caution. It's above a 5-day moving average, but it's yellow, meaning the calculation's still calculating down. Once we start discarding some of this prior data and we stay in these areas, it's going to flatten out to turn up. Q's, yesterday's video, we discussed how this is actually more bullish, and that could be a good sign for the market. We pulled in to the 5-day moving average today, and we started breaking through this trend line. Semiconductors, it was the same situation. Biotech is holding up rather well here. As you can see, we pulled into the flattening 5-day moving average, but we're starting to put in a higher low. So that was a higher low, higher low, higher low. So if you are trading biotech, this is actually not that bad of an area right here. And if we can hold, whether it be this level or this level, wherever you find your stop necessary, perhaps maybe this starts the potential change in trend. This is where you get, good risk to reward. You're on the right side of trend, and then you have higher lows to potentially use as levels of risk mitigation. The DIA is what's probably holding a big old SPY back over here, as this is still below a declining 5-day moving average. Now, if we take a look at just the daily time frame for the SPY, really we're just going sideways here, right? And if you look at this from any charting perspective, somebody would look at this, don't know that it's the SPY, whatever the case is, they would just be looking at this as just a bullish consolidation for the potential look for a continuation. We're above some key averages, we're above a prior breakout, we still see a series of higher lows and higher highs, so that's what I would be looking for. Now, like I said, what would change my opinion? What would change my opinion is simple: below a declining 5-day moving average, and in negative gamma territory. It is that simple. I am bullish above those things, and I'm cautious below it. I'm not really looking to short this market because of some of the other time frames, but that's how I would be approaching it. Take a look at the Qs. The Qs is starting to get a new closing high over here, as you can see, but we still haven't hit a new high like the SPY did. And that can be concerning, but it definitely feels as if the market's ready to try to press out and retest and or break this prior high. But overall, you can see a series of higher lows, a consolidation, and now we're trying to break through this consolidation. So is this like, hey, yeah, I'm going to short here because I'm bearish, whatever the case may be? In my opinion, no. Why? Because, once again, we're in positive gamma territory and we're above, especially on the Qs, a rising 5-day moving average. So if you're long, congratulations, right? This was a good entry right over here. I traded it today and I held on to some runners. And then I had started a position in biotech where my stop is going to be right under here. That was my level of risk. For the Qs, my level of risk is right over here right now. Now that might change. If we put up, I'm updating it. And if we come down, I get stopped out. Okay, it's pretty simple for the most part. Let's go ahead and hop over to the Sailor to Shift tool. The last time I discussed this, we were underneath this sell trigger area, but the candle hasn't fully closed yet. When the week closed, we closed above it. So there was no sell signal, official sell signal, and there is obviously no sell trigger. So the original buy signal was discussed over here in September. The trigger came 3 weeks ago when we crossed the high of this week right over here at about 65,000. And from that point, the market has been pressing higher, breaking out of this consolidation. Now, everybody, for the most part, is quite bullish. I'm seeing kind of mixed bags on a lot of things, but right now, it's on a buy signal, buy trigger. Until this changes, I'm bullish Bitcoin, bullish Ethereum, bullish some of the crypto miners. Just be careful because there's a lot of beta in those. I have positions. I've scaled profits out already. And now I look for consolidations and ways to potentially trade to see if this is going to be a longer, bigger breakout to something like, that big number that everyone wants, 100,000. That's all I got for you on today's episode. I hope it helps out. See you later.